A pioneer in public finance since 1955, Ellers helps clients build outstanding places to live, work, learn, and play by delivering focused, fully integrated financial advisory services. We work with more than 1,500 local governments, schools, development authorities, and public agencies, placing their needs and best interests at the heart of everything we do. We help our clients navigate all facets of public finance, including financial management planning, economic development and redevelopment, debt issuance and management, investments and treasury management, and arbitrage consulting. At Ellers, we believe strong communities aren't simply the result of transactions. They're the result of people. We build strong, long-lasting client relationships, collaborating with your staff to complete projects and drive new initiatives forward. Building strong, vibrant, and sustainable communities. Together, it's what we do. For more information, call us at 1-800-552-1171 or visit ellers-inc.com.
Good morning, everyone. Thank you for joining us today for Ellers' virtual session to discuss More Than a Checkbook, Banking and Treasury Management Best Practices. I'm Tammy Oshevsky, Senior Investment Advisor with Ellers, and I'll be serving as your moderator today. Before I introduce my colleagues and we get started, I just have 3 quick housekeeping items to mention that will help ensure you have a good interactive experience with us. You'll notice in the upper right-hand corner of your screen, there are 2 icons. One is called Live Q&A and the other is Chat. As we move through today's presentation, if you have a question or if you want to make a comment, please open the Q&A tab, type it in and submit. I will be monitoring those questions. We will take a few breaks during our time together to answer the questions you've submitted. You can also have conversations throughout the session with fellow attendees by opening that chat function. One thing to note, while you can submit any question anonymously, in the event we're not able to get to all questions today, we do recommend that you allow us to see your information so we can reach out to you directly with specific answers or to discuss further. Lastly, if at any point during our presentation you start to notice either video or audio lag, please go ahead and refresh your browser, and that should get you right back on track. Now that we've covered those items, let's go ahead and get started. I'd like to introduce first Ryan Miles, Senior Investment Advisor, to kick off today's session.
Thank you, Tammy. Good morning, everyone, and thank you for taking some time with us this morning out of your busy day to look at banking and treasury management services. Again, Ryan Miles, Senior Investment Advisor in our Twin Cities office and serving the Western Wisconsin area of our clients on the investment and treasury management side. We're just really excited to talk to you today about the banking and treasury management world as we think about the different nuances of banking and treasury management over the years. The complexity of this space has just continued to evolve. And so our goal today is to demystify and kind of walk through the various steps of primary cash management tools, various evolving banking scams, and scams have been in the news a lot lately, paying for bank services. So there's a variety of ways to think about how to best pay for services that you're utilizing, how to best manage your cash balances efficiently. Again, wanted to promote and think about the various ways to do that. And some of the ways are considering your balances versus looking at a sweep product or other sweeping arrangements to fully utilize all of your funds. And that complexity is difficult because of the various fund balances you all hold and the various fund types and how to organize that in a way that is most efficient for the municipality where you serve. And so as you evaluate banking partners, we also will touch briefly today on banking service RFPs. As you think about, is your banking partner or partners best aligned to in the best interest of the municipality where you work, and how do we evaluate that as we go through that? So we have a full agenda today, but again, we want to encourage you to certainly ask questions as we go through the process. We'll be stopping along the way, and we're happy to make this as interactive as we possibly can. So with that being said, I'm going to turn it over to Don Lawson in our Wisconsin office as well. Don is a certified treasury management professional as well as an investment professional on our team, and is going to take us through the first steps of primary cash management tools. So Don, I'll turn it over to you.
All right. Thank you, Ryan. Welcome, everyone. So our main goal in designing a treasury management system is to establish a framework that utilizes the bank products and services that best fit your needs at the lowest possible cost. So even if you do pay your fees with balances, you can minimize the balances needed. Now, the key is to automate and streamline whenever possible. This is going to help reduce your bank fees, reduce your personnel costs, and reduce human errors. Just remember, going paperless does save you time and money. So we're going to start off and take a look at the cash management tools that your bank offers to help you with your collections, and then we'll move on to disbursements. So still, the most common way to get your funds into your account is to walk them on into the branch. In addition to walking them into the branch, you may have a local bank that's willing to accept tax and utility payments on your behalf. This will help keep some of the foot traffic out of your location and put it into the bank's location. Alternatively, too, you may use a desktop scanner for remote deposit. So you scan the checks that you have for deposit into this little scanner. It creates a digitized image file. You then transmit those images into the bank for deposit instead of taking in the paper checks. You then hold on to those paper checks for a period of time, say 10 days, maybe 14 days, and then you shred them once the images are processed. Even though they're digitized images, the bank still processes them as if they're checks through the checking system and according to the Universal Commercial Code or the UCC regulations for checks. Now, if you have a fair amount of coin and currency, you may also hire a courier that will transport the coin and currency to your bank for deposit. Now, couriers are very expensive, and so banks have come up with what they call a virtual vault, which is just a safe that you keep in your location. And as you have currency and checks, you can scan those into this vault, and then you get credit on the day that you scan them into the vault. And then the courier picks them up periodically, depending on your volume. It may be, once a week, once every 2 weeks, maybe even once a month, and then takes the coin and currency in for actual deposit. Now, another way to get your funds into your account is through an ACH debit origination. ACH is an automated clearinghouse. It's just part of the Fed that processes electronic payments. And an ACH debit file is really like a direct deposit file in reverse, but it contains the same information and works through the banking system in the same way. So your constituents will provide their banking account information to you, and then you transmit a processing file to your bank. Okay, so some common applications are for utility payments, retiree collections such as healthcare premiums. Another product that is offered usually in conjunction with that remote deposit scanner is called check conversion. So I'd mentioned with remote deposit, a bank, it stays as a check, is processed as a check. With check conversion, it's taking that image and it's actually converting it from a check into an ACH. And there's a couple of reasons why you might want to convert from a check into an ACH. Remember when I told you that you're going to save time and money if you convert to a paperless transaction? Here's why. Your bank account fees are less for an ACH than they are for a check deposit. And if that check comes back NSF, the fees for an NSF in the electronic world are cheaper than they are in the paper world. So you would save on NSF fees. You also get an extra presentment in the electronic world. So if you deposit a check and it comes back NSF, you can redeposit it once. In the electronic world, you can redeposit it twice, and you can even time it. So you can redeposit it, say, on a Friday or on the 1st or the 15th, when there's more likely to be funds in the person's account. Banks still process their electronic files before their paper files too. So if there's limited funds in the account, you're going to be first in line before any checks get cashed against the account. So in addition to the items that we just talked about, online and mobile, of course, is very popular. And so you may have people that want to send you funds electronically through their bank's bill pay or a service such as PayPal. You may also partner with a third-party vendor to collect payments on your behalf. vendors such as PayPal for local governments, FIS Global, Elevon, ACI Payments. And generally, you can collect either what's called an e-check, which is really an ACH, or via credit card. So you can collect either of those using either of those vehicles with online and mobile payments. Now, Perfect Receivables is a nice system where if you're having people that want to send you wire transfers or ACHs and you don't really want to give them your banking account information, Perfect Receivables uses a proxy account number that you provide to your vendor. And when that payment comes in to the bank then maps that to your actual account number. So it's a way to get electronic funds into your account without having to put your bank account information out there, which is a good way to prevent fraud. And then, of course, credit cards. We use credit cards a lot. You might use them to collect fines, permits. You might use them at golf courses. So there's a number of uses where you're collecting funds using a credit card. All right, so we've talked about collection tools. Let's move on to disbursements and some of the products that banks offer to help you in that regard. Now, fraud protection is a major thrust for banks in trying to protect your assets. So some of the products that they have come up with to mitigate fraud include Positive Pay. And Positive Pay is simply a way for you to send your issue file to the bank. Ideally, the check number, dollar amount, and the payee name. And when the checks come into the bank, then to be processed, they match it up against the file that you have sent them. And if something doesn't match, then it becomes a suspect item, and they put this suspect file out on your online banking for you to make a decision about whether you're going to pay it or return it. So maybe it was a manual check and you forgot to include it in your issue file. Great, fine, you hit pay and it goes through. However, if it doesn't match for whatever reason, maybe the dollar amount's been altered or the payee name has been altered, or maybe somebody just made a photocopy of a check and it's a duplicate. Any of those cases, you hit the return button and it goes back to the bank of first deposit. No questions asked, and it's not your problem. You don't have to waste time filling out affidavits of fraud or forgery trying to recoup your funds. Two examples of from when I was in the banking world. I had a client, a large payer in the Fox Valley, and they did not utilize Positive Pay. And on payday, one of their employees walked into the local bank branch there. And before they got into the bank, they were intercepted by someone that identified as an employee of the bank and said that the bank was having technical difficulties, the computers were down. And so they were going to try to help, mitigate the problems by cashing the payroll checks. And so the employee says, all right, fine, hands over their payroll check, and the person hands them the cash for it, and the employee walks away. And the fraudster then had the bank account information for this large corporation, and they started issuing checks drawn on that bank account. And so then my client calls me and says, so how quickly can we implement Positive Pay? And it is a very inexpensive insurance policy. I know you may say, gee, I've never had fraud, and that may be true. But all it takes is one instance, and you're going to regret not having it. One other quick example, I had a large municipality who did have Positive Pay, and they wrote a check for a large telecom purchase and put it in the mail. Well, it was intercepted before it made it through the U.S. Postal Service to their vendor, and the payee name was altered. Well, because this municipality did have Positive Pay, it was caught and rejected and returned, and they didn't have to waste any time trying to recoup their funds. Unfortunately, fraudsters don't only work in the paper world, they also work in the electronic world. And so banks have come up with something called an ACH debit filter or block. A debit filter works much like Positive Pay does. If you have certain originators that are allowed to take money out of your accounts electronically, such as your payroll processor or the state of Wisconsin, you can pre-authorize certain issuers. You can also authorize up to a certain threshold. You can authorize certain specific transactions for specific dollar amounts. An ACH block is for accounts that don't have any electronic activity against them at all. And so if someone does try to take money out of the account electronically, the bank rejects it automatically, and you don't even know about it. They don't even tell you. They just automatically reject. So another fraud prevention tool, particularly for certain types of activity that you might do through your online banking, such as initiating an ACH file, or doing a wire transfer, or uploading your positive pay file, has to do with tokens. So your bank may provide you with an actual physical fob that's kind of looks like a little keychain, and it has a random number generator that changes about every 30 seconds. And so this is an added layer of security when you're on your online banking. Now, a virtual token is a very similar type of system that generates a one-time 6-digit code, changes every 30 seconds, and it's like an extra password. Okay, so you have to have your user ID and password plus this 6-digit code in order to initiate transactions or to log into your online banking system. Now, we also use mobile devices, and so be sure that your mobile devices are secured, whether it's via a password or a fingerprint, and make sure that your connection is secure. Don't sit down at Starbucks on their Wi-Fi and initiate a wire transfer. So make sure that your devices are secured. All right, so another disbursement tool that you might use is a purchasing card. A purchasing card is just a special credit card that you provide to your employees to make small dollar purchases. Everybody draws the line at small dollar purchases in a different way, but we'll use $1,000 as a good example. So you may be buying some office supplies, or maybe putting fuel into a fleet vehicle, or buying, food for an office meeting. So the employees are utilizing these cards. There's various safeguards that you can put in place. So you can put limits in there by day. You can limit per transaction, per month. You can limit where the card is used by merchant category code. So that fleet vehicle, maybe he can only use it at gas stations. You can even limit it further. So if he walks in to get a bottle of water at the convenience store at the gas station, it would reject at that point. So you can be very specific. It's very common, of course, to turn off gambling locations as well as jewelry stores. The nice thing about a purchasing card is, like any credit card, you can see the online activity on a real-time basis. So you know very quickly whether your employees are purchasing things that are inappropriate, or that you don't want them to be buying, and you can address it much quicker than you might in an expense reimbursement situation. Now, the nice thing about a purchasing card is you can piggyback off of the state of Wisconsin banking contract. They work with U.S. Bank, and U.S. Bank and the state of Wisconsin have an arrangement where local government entities can piggyback off of that contract, which of course has very advantageous pricing. And so you can utilize their purchasing card contract, and you may, not only is purchasing card a good way to save money because it helps you to automate and streamline, it's rare that you will pay fees. Okay, so it's usually the merchant that's paying the fees, and it can even be a profit center because you may be able to earn a rebate based on the spend that you have on the cards. You may actually get a rebate, much like a rewards card. Automated clearinghouse and wire transfer are another way to make your payments. So if you're making vendor payments or payments to the state of Wisconsin, or bond payments, that kind of thing, you can use ACH and wire transfers. And direct deposit of payroll, of course, is a very popular electronic payment method. Simply sending a file to your bank for processing, or through your payroll provider. Your employees provide their bank account information, and you put their paycheck electronically into their bank account. And pay card is a way to electronify those employees that either don't have a bank account because they don't want one, or maybe because they can't have one. And so a pay card works much like direct deposit or payroll. You as the employer transmit a file to the bank for processing, but instead of a bank account, the bank provides you with a like a shadow account. So to you, it looks like direct deposit, but when it gets to the bank, they load this credit card. It looks like a debit card. It's reloadable. And the employees then get their payroll money off of the card, much like they would any debit card. They can use it at point of purchase. So they can walk into, Walmart or the gas station and use it like a debit card. They can use it to set up direct debits from like their utility payments. They can walk into a local branch and get cash, or they can get funds at an ATM. Now, pay card is the most expensive way for you to process payroll transactions, and the employees may also have some fees based on how they're going to access their funds. If they're going to, get them through an ATM, they may incur ATM fees. Okay. And so then we're going to turn to kind of a couple of final bank tools that you might utilize. We've talked quite a bit already about online information reporting and how you might interact with your bank. You can look at your balances and your transactions, input your positive pay files, take a look at your positive pay suspect items, originate direct deposit payroll files or vendor payments, wire transfers. One last product that I wanted to talk about has to do with funds that you keep in your account and a way that you might be able to earn some interest on them. So a sweep account is simply an automated way that the bank can transfer money out of your account into an overnight investment vehicle. So you earn interest, and then the next morning they sweep back into your account automatically. So it's not a transfer that you have to make, it's automated. And there's two underlying vehicles that you can transfer to. The first and most common for local governments is a repurchase sweep. And the reason for that is because it's collateralized at 102%, which meets state statutes. And it's invested, the underlying investments are U.S. Treasuries and U.S. government agency bonds. And so they meet the collateral requirements that are suggested by state statutes. Now, the other vehicle that you can utilize is a money market account. And the reason you might want to do this is they generally pay higher rates than repo sweeps, but you need to make sure that the underlying securities meet state statutes. And keep in mind that they are not FDIC insurance covered, they're not collateralized. You may be able to get a government or a treasury fund, which is great, but keep in mind they are still not FDIC insured or collateralized. And now we're going to turn it over to Ryan, who's going to talk about how creative fraudsters can be.
And they have been pretty creative lately, as of late, and continue to evolve. Thanks, Don. This has been a really good first section to look at the ins and outs of banking, of the ways to collect money, to disperse money, to protect yourself. And before we talk about specific types of scams from fraudsters, I think it's also connecting from this prior session as thinking about ways to protect your account with ACH filtering and blocking and positive pay. Nowadays, because fraudsters are becoming so effective, oftentimes if you are not taking advantage of these account protection tools at the local bank, I've been hearing stories and reports that now banks are having you sign off generally that they are offering you these fraud protection tools, and you have the ability to accept or reject them. And if you decide to not sign up for some of these fraud protection tools, that does create a little bit more of a liability for you at the local bank, where the bank, as far as if there was something to happen, they have. There are some ways that they can say that they have at least offered you the tools and you have decided to not take advantage of them. So our story today, our theme today is to look at the most, all the different ways to protect yourself in the accounts, and certainly from within the bank as well as within your own systems at your municipality. And there's four main types of fraud or scams that are happening these days. And we're hearing more and more reports about them also going after, smaller municipalities or smaller school districts where maybe some of the different account protections or technology hasn't been fully implemented, so there might be some additional fraud risk there. So one of the first main ones is imposter fraud, where you might get an email from a city administrator saying that we need to send funds, we need to wire funds to this different vendor, but I'm in a meeting right now and I can't double check. Can you just go ahead and send these funds over to this person? And it's close enough that it might sound legitimate, or to pay a vendor or an IRS or a demand type of funds. And there's really an imposter type of fraud, or a CEO impersonation fraud is one thing to be considerate of. As we think of these frauds, a lot of times they're impostoring, they're taking over accounts, they're trying to get in the middle of the transaction. And one of the key ways to verify that is not the case, or not the person, is to really, they call it out of band authentication. So if you were to get a cash request via email from maybe somebody that you think that is legitimate, but it might be an impersonation, to call that person. So that's going outside of that communication system, and that could then verify that might be a legitimate transaction. Takeover fraud, where that fraudster might, by clicking on a link, could then have access to your system and be able to actually get into your bank account and be able to initiate a wire out, or an ACH out, or some other way to send funds, or to even have access to your account and routing information. So they can pull money out of your account as long as they have an account number and a routing number, if there isn't a way with Positive Pay or some of the blocking mechanisms to stop that from happening. Ransomware, this has been in the news a lot lately, where if that fraudster is able to take control of that computer or that network, to actually lock it down, either at the bank level or even for that municipality level, and ask for ransom to actually be able to log back in and utilize your tools. And so, as you think of, what would the cost of a ransom or locking down a system at your municipality, just the time cost and the operational cost and risk that it would impose, as you think about the various fraud mitigation tools available at your local bank, it shows the value of it's really worth looking and paying, and as Don said earlier, some really cheap insurance to try to mitigate these as best as possible. Another type of fraud prevention tool at the bank that is coming out recently is IP address restrictions as well as time restrictions. And so say that the fraudster might be able to take over your computer or your account, but if you have set it up at the bank that you can only log into your bank account between 9 a.m. and 5 p.m. And nobody else can log in after hours, you can set up IP restrictions as well as time restrictions, or the IP address from your computer could only be one that could access that bank account. So there's a few other tools here as well. And then the man-in-the-middle scam, where they are looking to steal that data and really go fishing for not only just your banking information, but other information within your municipality. So the keys as we think about scams is really that out-of-band authentication, if there was a way to verify what is being communicated, as well as looking at ways to restrict access from a different time perspective, a certain computer perspective, and then being able to control the money in and the money out. So really this comes down to, as we think about how to best protect yourself, understanding what your bank can offer as far as fraud or risk mitigation tools, and really having that conversation with them as making sure that you're best structured to prevent that, as well as your technology team or technology department within your municipality thinking through some of these risk mitigation as if there was a scam to be hold on your municipality. So it's a key component as we think about just the risk out there these days, and what one of these frauds that would maybe be perpetrated on municipality, and the cost that it could really impose from a time or cost standpoint as well. From here, we're going to take a brief pause, and we're going to go to some Q&A questions and hopefully answer some questions regarding the various tools that are out there from a banking in and out perspective, or cash management tools, or a fraud perspective discussion, and the ways to protect yourself against scams. So I'll turn it over to Tammy and lead us in that next discussion.
Thank you so much, Ryan, and great job so far, Don and Ryan. We do have a few questions from the group here. So first off, first question that we've seen here is, where can you find the state contracts and start using them? I'm assuming that's for the P card that you had mentioned.
Right. I would reach out to US Bank. So just take your local US Bank branch and contact them and let them know that you would like to get the contact information for the US or for the banker who's responsible for the state of Wisconsin.
And that P card is a really nice system that they offer. It's very cost effective, and the real time data that you as an administrator can have, you have the ability in real time to restrict and to turn off and turn on cards, and really they provide those tools at your fingertips in real time. So it is a really nice program to look at.
Great, thank you both. And then another question here is how challenging is it to switch banks with all of your automatic payments coming in like bill pay?
So if they're coming in via bill pay, it doesn't matter when you change banks. It's frequently, even though you're the person who's paying the bill thinks that it's electronic, you're probably actually getting a check in the mail. So even though they sit at their PC to initiate the payment, it's probably coming to you as a check, unless you have set up with your bank to get what's called electronic receivables, and then that item will stay an electronic item, and you'll get that bill transmission from your bank. So if you change banks and you have electronic receivables set up, you will have to change that, and it is a little bit painful, just like changing any service. When you change banks, it is a little bit painful, and we'll talk about that a little bit later when we talk about banking services RFPs and things to consider. You do want to make sure that you're running in tandem for a few months to make sure that you are recouping all of those electronic payments. Ryan, anything to add on that?
Yeah, and just maybe to add that as you're evaluating additional banking partners, you'll certainly want to ask how they have them speak to what would be their transition plan to help you with that, and what is their level of technology that they could help make some of those transitions happen. There are some new technologies out there that can ease in some of those switching ACH, to the new bank and various components. So it certainly is a transition, and it is an undertaking, but it's sort of that cost benefit analysis of a little bit of pain to think through that, but is there a time savings or a cost savings certainly from your banking fees, and then evaluating that as that new partner, can they help you with that transition?
Great. And then one more question here before we move on. Can you provide any resources for training employees on banking scams and fraud?
Yeah, let's do it. We love these educational components, and so if we could host additional a brief mini session, a lunch and learn webinar session, if this would be helpful to talk through just specifically banking scams and fraud and the banking tools. Don and I both have a long history in banking background, so I would be happy to talk about that as a former banker, and we wouldn't have a specific bank to recommend. We're just looking to add value and help you think through how to best align your team and really creating that training component to protect yourself as best you can.
Great. I'm sure everyone is going to reach out to you and ask you some further questions about that. But moving on, we will go ahead and jump in, and Ryan is going to walk us through typical bank fees and the key strategies for managing cash balances effectively.
Thanks, Don, and thank you all for the questions. There's going to be a few more questions, or a couple more times to pause, and certainly keep the questions coming. So as we think about, certainly there's all sorts of different bells and whistles you can have from a fraud protection standpoint, and they all do come with a fee, right? So And there's a variety of different ways to pay for your fees. And we'll get into some of the details here and a little bit later, really with your account analysis statement to determine what's the best way to pay for your fees. So the banker might have one perspective, but we want to provide just the holistic perspective and your options for you as you think about what are the best ways to reduce your fees. So there are a couple main types. A hard charge is considered a fee that generally cannot be reduced, and just either it's your monthly monthly statement fee or account analysis fee, some sort of hard charge. I will pause and say that in the world of banking fees, generally for a municipality, because of the size of deposits or the transactional volume that you're going to have, even though it might be called a hard charge from your banker and they might say that this is the monthly fee, I would say that really any sort of fee that you're paying for is negotiable. Your local banks are certainly looking for larger relationships, and yours would be no exception. And so even though it might be considered a hard charge on their pamphlet, all these charges would be negotiable as you think about the right banking partner. But those hard charges or whatever fees that they might be charging you could be offset by an earnings credit. And so we'll get into that of how we calculate an earnings credit and maybe why the benefit of doing an earnings credit versus paying for charges. We're also looking at your compensating balances. So the balance in which you carry at your local bank, there's an opportunity cost for everything in what we're doing. So you might be carrying a large balance and then not have any fees, but what would be the sweet spot for a compensating balance? Honestly, it might be worth paying some fees to the local bank to then have a few extra dollars to do for other things and reducing that opportunity cost. And so we'll go through some calculations here a little bit later with Dawn about where is that sweet spot from an opportunity cost standpoint of what sort of compensating balance should you carry to either offset your fees or to actually pay fees and then come out ahead in the long run by freeing up some of that cash. Really the way to evaluate that is through your account analysis statement. And so you're getting your monthly statement showing all the checks that were written or all the deposits that were made, all the ACHs and wires. But there also is a statement either monthly or quarterly from your bank that does outline specifically just your fees. And it's called an account analysis statement. And if you're not receiving one, definitely ask for that. And that's the key way to evaluate the fees and services that you're paying for at the local bank. And we're gonna drill down into that in the weeds. It's definitely in the weeds on how to evaluate that analysis statement and making sure that you're covered appropriately from your banking services standpoint. So as we think about how to manage your overall cash balances efficiently, there is that conundrum of how much should we carry in cash. There's a sweep component. We can sweep money out. We can sweep money in. There's a charge for sweep services. We definitely don't want to be having all of our money tied up in a money market account or in a CD or other investments and not have sufficient cash. So how do you think through the large balance for bills and other emergencies versus the liquid cash, knowing that the cash that you hold in the local bank or even the LGIP are really the lowest rates of return that you're going to be able to get. And anything over and above that's going to cover your fees, oftentimes banks might not even offer an interest rate. And so, or you might not even have full FDIC coverage protection or the state guaranteed pooled product as well. And so there are a lot of different pluses and minuses as you think about the appropriate balance to carry. And so, as we think about that, the answer is it's different for every municipality, right? There is a sweet spot for, depending on the size of the municipality and the transactional history and load of which you're dealing with each of these funds, whether it's a debt service fund or your general fund, right? They have different components of how they're managed. And so, a debt service fund can be a lot more illiquid because there isn't as much transactional history coming out of that fund versus your general fund, for example, with all the payroll and the various ins and outs. And so, but there are opportunity costs. And so as you think about that, that's something that we'll try to help evaluate or how to best calculate that. And so as we were talking about the LGIP as an example for a fund, let's look at that of the volatility of cash. If we take a look at our next slide here, Thinking about your cash balance, we're all familiar with the Wisconsin local government pool. What I did is I just charted what was the rate of return every month, going back as far as we can with their published report back in 2012 up until today. And so as we think about cash balances, either at the local bank or at in the local pool, cash we call it, is one of the most volatile investments that you could possibly hold because there is certainly no opportunity for you to control those rates, and certainly the Fed and market factors are controlling what's happening with the rate, but the rate is extremely volatile. So you think about the early 2012 to 2015, 16, the rates of the cash balances were very, very low. They rose rather quickly, and as fast as they rose, they also dropped rather dramatically as well. And so cash balances have the volatility that is very difficult to add into your budget from an investment earnings component, or just overall earnings for your municipality. So our perspective is that cash is certainly appropriate to cover expenses, and then figuring out how much is needed, and then looking at other longer term investments to maybe balance out the volatility of cash, because it can go from 2.5% just a couple of years ago to down to 0.05% is the local government pool today, and likely to continue to stay low for a number of years in the near future. So that's a key component as we think about this. So as we think about how do you align a strategy with your cash, your investments, it really does start with building a strategy. And so we'll talk here briefly about that too, and then we'll look at some more details as well. So really, there's three components to manage your cash efficiently. But it all starts with building a cash forecast or a cash flow forecast. Before you can even analyze your banking services, developing that cash forecast is one of the most critical ways to just know the seasonality of your disbursements and your receivables, and what's the flow of funds. And certainly from the state payments to your sales tax to various other components. Understanding that cash forecast, it can be done as high level or as complex as you need it, again, depending on that municipality. We recommend building a 12-month cash flow and looking at that over that period of time, and then that cash flow will likely have a cyclical nature to it every year as we go forward. So as you think about that 12-month cash flow, the key is to keeping it to current and committing it to paper. So where do you start? Sometimes it is difficult, but it's looking at your debt service payments, your state monies coming in, taxes, your payroll, your large expenses, the money's in and the money's out, and starting there. And you can get more detailed and nuanced as you go along, but building that out, and you'll see some cyclical nature. And then as you have that, you're able to then evaluate some of these banking partners. As you know that, you can then you can look at their banking services. With your banking services, if you're flush with cash during periods of time or in the year, are those earnings credits sufficient to not only cover your costs, but are they also paying you a rate of return? Are you using what you're paying for? And are there things that you maybe want to take advantage of that you aren't currently using right now, as some of those fraud mitigation tools, as we were talking about earlier today. So that because your cash fluctuates significantly generally on the seasonality of your cash cycle, the strategy could change throughout the period of time. Can you switch from some hard charges or even some earnings credits throughout the year based on the cash balances you're gonna carry? And then finally, again, building the cash flow to understanding your banking partner and the costs they're charging and the benefits they're providing to you. Do you have excess liquidity then that maybe you could invest? You could invest out a little bit longer, and then if so, for how long could you? So oftentimes you could look at investment strategies to align with larger debt service payments throughout the year, so more of a targeted strategy, and building some regular maturities to align with that. But then what are your as we talk about the fluctuations in your bank account, what will be the impact for those charges and fees as your cash fluctuates? And so maybe there is a core cash reserve that you want to keep in at any given time, that and then any excess you're going to pull off and invest those balances based on your investment profile. But a $500,000 sweep balance at any given time, you're just going to make sure that that's always in the account. And what sort of impact would that have on your fees, and then also the compensating balances that you need to cover for those? So a lot of different components to think through. And so our goal today is to just help you think high level from a strategy standpoint, and then also provide some tips and resources to think about as you drill down for your own example, what's the best way to tackle some of these core projects. And so Tammy, Don, and myself are willing to certainly get in the weeds a little bit with you more on an individualized basis too, and talk about this, certainly after the fact. But getting in the weeds, let's do that a little bit more. So we're going to turn this over to Don and talk about really how can you start evaluating in some of the expenses and looking at the account analysis statement. So Don, I'll turn it back to you.
Great, thank you, Ryan. So as Ryan indicated, your account analysis statement, it's really just the invoice that the bank provides to you that itemizes all of the products and services that you're utilizing with them. So if you don't currently get an account analysis statement, please ask your bank for one. It is one of the key ways that you can make sure that you are utilizing all the banks and all the products that you're paying for. When I was in the banking world, I can't tell you how often I sat down with my clients and was going over the account analysis statement, and they would say, we have, this and this product. I'm like, yeah, you had it for, 8 months or whatever. And they're like, oh, we didn't even, remember that we had that. We haven't been utilizing it, but we've been paying for it. So when you look at your account analysis statement, it's really broken down into 3 sections, if you will. The first is going to be the balance summary. It shows you your balances, and then it's those balances that are then used to determine with an earnings credit rate how much fees those balances are going to offset or pay for. So the balance summary has 3 different balance numbers. The first one is the ledger balance, and that is just your gross number. It's the biggest number, and the ledger balance is decreased by the float amount, which then becomes the collected balance. So when you deposit checks, they're not immediately available usually. It may take a day or 2 before those funds are available for you to use or collected. Okay, so the ledger balance minus the float equals the collected balance. And then the Fed requires U.S. banks to keep 10% of their reserves at the Fed, and they don't pay them interest on those balances. And so the bank says, well, we're not going to pay our clients interest on that 10% of the funds that we have to keep at the Fed and we can't do anything with. So the difference between the collected balance and the investable balance is that 10% reserve requirement. So it's that investable balance that the bank is then going to pay you an earnings credit rate on. And the earnings credit, or the ECR, is simply an imputed interest rate. And it's different for every bank. They set their own earnings credit rates, and they're usually based on something like the 90-day T-bill rate or the Fed funds rate. So it's a very short-term rate that changes up to monthly. So they utilize this imputed interest rate then based on your investable balances to help determine how much interest you would earn, and then they use those imputed interest earnings to offset the fees for your services. So then the final section is the detail of all the products and services that you utilize, the associated volumes, how many checks you wrote, how many checks you deposited, if you used remote deposit or positive pay, all the volumes, and then at the unit prices to give you your total for your fees for the month. Now, as Ryan indicated, it's beneficial for you to try and analyze these fees on a less frequent basis than every month. Monthly is the standard, okay? So they'll take a look at if you had enough balances to offset your fees, great, fine. Banks usually don't pay interest on your what we'll call excess balances, which are just the balances that are higher than what you needed to pay for your fees. Some banks will pay you interest on those excess balances, but it's certainly not the norm. So if you can analyze your fees on, say, a quarterly, semi-annual, or even annual basis, if you have months where you have a lot of balances, say tax collection time, you can offset those against maybe your summer or fall fees where you don't have very high balances and you might pay a lot more in hard charges because of that. So you can even out or, keep from having the peaks and valleys where you pay fees some months and have excess balances some months, okay? So I recommend that you do this at least annually. Okay, so let's take a look at some rates. Their earnings credit rate, as we've talked about, Ryan mentioned, rates are at an all-time low for short-term rates. Might be 0.1%, 0.2%, and the longer we're in this low-rate environment, the closer they're going to come to that 0.1%. Repurchase sweeps have also come way down, and they're probably more, in the 0.15 to even 0.1% now as they continue to fall. To just give you an idea on 12-month certificates of deposit, before COVID, it was 1.7% for a one-year CD, and nowadays it's 0.05. So rates have really, really come down, which means that as earnings credit rates come down, you may be paying hard charges for your bank fees where you didn't used to pay fees because you had enough balances that paid for them. So Ryan talked about the importance of coming up with a cash flow so that you can determine, if you're going to pay with balances, what are you going to need? How much balances will pay for your fees? And what do you do if earnings credit rates are lower than sweep rates? So we're going to go through some examples of how you can do an analysis. And I recommend doing it probably on at least a quarterly basis. So first of all, if earnings credit rates are greater than sweep rates or other investment rates, you may think automatically, well, gee, then you ought to be, leaving your balances in your account and paying with your balances. And that may not be true. It may be true, but it kind of depends. And the main reason for that is FDIC charges. Now, banks have to pay FDIC charges, and they're different by bank because they're assessed by the Fed at based on the bank's credit quality. So if your bank has a very high credit quality, their FDIC insurance charges are actually a little bit less than another bank who maybe isn't quite as secure. Now, banks pass those fees on to you, and this can literally be the highest unit price that you're going to pay for any of your services. In the examples that we're going to go through in a little bit, actually half of the fees are FDIC insurance charge fees. So it's a very significant charge. And this is one reason that earnings credits might not be the best way to pay for your fees. If sweep rates or investment rates are greater than the earnings credit rate, it's almost always going to be the case where you should sweep or invest as much as you can. Now, this means that you're going to pay bank fees. You're going to pay hard charges. And I know nobody wants to pay bank fees, but if you're going to earn more in interest than you're going to pay in fees, you're better off from a bottom line standpoint to go ahead and earn the higher interest and pay for your fees with those interest earnings. Okay. And then the third thing that we're going to look at is if you have more balances in your account than you need, well, those are called excess or free balances, you're always going to want to sweep at least those excess balances. So if you need $5 million in your bank to pay for everything, but you have $6.5 million, you're always going to want to at least sweep that $1.5 million to earn interest on it, because again, banks don't usually pay interest on excess balances. So the other thing is that if you sweep funds, you're going to have collateralizations. Remember we talked about that repo sweep? So if you're sweeping, those are going to be collateralized with U.S. Treasury bills, U.S. agency securities. FDIC insurance only covers you up to $250,000. Okay, so if you happen to have $1 million in your account, If you haven't made arrangements with your bank to collateralize those funds, those are unprotected. Okay, so an advantage of sweeping is that you have that collateralization automatically and you don't have to worry about it. All right, so let's talk about some specific examples. The first one assumes that we have a balance of $4.5 million. Our earnings credit rate is 0.2%. The sweep rate is 0.15%. The FDIC charge on the average ledger balance, that's ALB as average ledger balance. If you're going to keep all that $4.5 million in your bank account, that charge is going to be $607. If we're going to sweep, the fee drops down to only $68. And the reason that you still have some fees is because that FDIC insurance is assessed at the ledger balance level, but you can only sweep investable balances. And so the difference between the ledger and the investable balances still has to stay in your account, and they're going to charge FDIC insurance on that portion, okay? So you don't have a sweep fee if you're going to leave all your money in your bank, but if you have a sweep, they charge a fee for that. And again, fees are going to be different at every bank, but $100 is a pretty common sweep fee. So under the balance method, your monthly service charges are $1,225, okay? Because of the lower FDIC insurance charge, but that $100 fee, the products and services that you're going to see assessed a fee is $786 if you're using a sweep. Now, under the balance option, you're going to earn earnings credits of $750 based on that 0.2% on the $4.5 million sweep. You're not really going to earn anything because there's no investable balances there. But you're going to have sweep earnings of $563. Okay, so that's the 0.15 times the $4.5 million. So in this instance, the benefit of using a sweep and paying hard charges is $251. So you would have hard charges under the balance method of $475, but under the sweep method, it would be $224. Okay, so in this instance, you're better off paying a sweep, even though the earnings credit rate is higher than the sweep rate. So in the next example, we've assumed that the sweep rate falls dramatically. And so the earnings credit rate stayed at the 0.2%, so that column is all the same. But now the sweep rate dropped, and so the sweep earnings fall significantly. So in this case, it's $124 cheaper to pay with balances and not use a sweep product. All right, the third example assumes that we have more money, okay? Because rates are still so low, you have to have a lot of balances to pay for your fees. But in this instance, instead of having $4.5 million, we now have $6.5 million. And so the FDIC insurance charge has gone, or we actually have $7 million. FDIC insurance charge has gone up to $839, which means the monthly service fees go up. But because you have higher balances, you're also earning more in terms of earnings credit rate. And so your hard charges are going to fall down to $376 per month. Now, over in the sweep, we're assuming that we're only going to sweep $1.5 million. So the $5 million is still going to be in your checking account, and that's going to help you to offset some fees. And we're going to earn 0.15% on that sweep. So with the earnings credit of $833 that you're going to earn because of the money that's sitting in there, and your sweep earnings of $188, the hard charges under the sweep method would be $207. So the benefit of using a sweep for some of the excess balances and paying hard charges, you're going to be $169 better off. Okay. Now, if you were to have, even more money, I guess, so you have, say you needed $8 million to completely offset your fees, but you had $10 million, you're going to want to make sure that you at least sweep that $2 million because you're not going to earn interest on it unless you sweep it generally. All right, so the last example, number 4, we are going to take a look at adding in an investment column. So the balance in the sweep, and now we're going to assume that we can take that same $4.5 million, but because you've done your cash flow forecast, as Ryan talked about, you've determined that, you know what, I really don't need that much money in my account. I can actually take it out and invest it longer term. Okay, so the first column assumes that we're paying with fees, and you're going to have a hard charge of $475. If you sweep, you would pay a hard charge of $224. But if you can take that money out, and we've assumed that you can put it in a portfolio that has laddered investments, it just means that you have regular maturities, and the average weighted maturity is going to be 4 years. So we looked at a 4-year rate, which is now about 0.6%, which I know doesn't sound exciting, but it's significantly higher than the earnings credit rate or the sweep rate. So based on the numbers here, you could earn $1,564. Well, you'd earn $2,250 in interest income, but because you're going to have to pay hard charges of $686, you're going to net $1,564. So you're significantly better off if you can take out the extra liquidity that you might have in your bank account and put it to work for you and reduce that opportunity cost of keeping too much liquidity. Okay. All right. So what have we learned? We learned that it's important to develop a cash flow forecast so that you can minimize your excess or your uninvested balances because there is an opportunity cost. You can utilize those funds and invest them so that you can, kind of reduce your bank fees and optimize your investment revenue. We talked about how there are different ways to pay for your bank fees. You may have some fees that are hard charges. Some banks will only allow you to pay for, say, a wire transfer with a hard charge. You cannot pay with your balances. Additionally, if you don't have enough balances, the banks will charge you whatever the difference is between your earnings credit and the charges, and the difference will be a debit against your account. You can utilize compensating balances to pay for your fees, along with an earnings credit rate, or pay those hard charges. So there's different ways to take care of your fees, and it's something that you can sit down with your banker on a regular basis. Like I said, I would do it at least quarterly to determine, based on the prevailing interest rates, what is the best way for you to take care of your fees. And now we're going to take another quick break to answer any questions that our viewers might have.
Thanks, Dawn. So we do have a few questions from the audience. The first one is probably, we get this question pretty regularly, so I'll leave it up to you two who wants to respond. The question is, rates are so low right now. Isn't there a lot of work to move my funds from checking to an investment account, only to move back to checking when I need the money?
That's a good question. Just kind of the cost benefit and of doing all that. I think that's where building that high level plan, that cash flow forecast, so that you're not as tight. And some of these tools that Dawn mentioned, that sweep arrangement, so that you never feel like really finding what is your low watermark of funds that you need to carry in that account at any given time to ensure that payroll is covered and some of those larger debt service payments or other large costs are covered. But then in ACH, if you have the right tools at your disposal with that local bank, the flow of funds could be rather quick and rather easy to do. And so the goal today is to demonstrate the kind of the proof of concept, and then it's up to each municipality based on the dollar amount that you might carry in those balances to sort of evaluate kind of that cost benefit of the time of doing that versus the interest earnings that you would have or the fees that you might offset. So Dawn, do you want anything else, your thoughts about that?
Yeah, I would agree, Ryan, especially when rates are low. You're right. You don't want to be transferring funds back and forth on a regular basis. It's ideal to look at that cash flow forecast and determine long-term what your investable balances are so that you're not going back and forth too frequently.
Great. And this next question actually is a good follow-on. The question is, how frequently should I be updating cash flow projections and move cash balances around?
Yeah, that I hate to say that it always depends, but it does depend on the size and the complexity of your municipality, right? So, and the different your chart of accounts, how many different accounts you have, and what are your goals? I think it's maybe taking a step back to determine what are your goals with the flow of funds and the appropriateness of the program that you want to undertake.
That's great. And a couple of good questions there. So now we're going to switch gears a little bit and we'll talk about banking services RFPs. So now I'll ask Ryan to start that conversation.
Thanks, Tammy. Yeah, so we definitely drilled down pretty deep in the weeds of thinking through investment balance and sweep balance and your earnings credit. Now let's step back a little bit bigger again and thinking about just your banking partners that you might have and to consider when an RFP might be necessary as you making sure that you're aligned correctly. So why would you want to consider switching banks or even going through an RFP process? So these are just some high level things to maybe think about from your standpoint. Having a periodic relationship review is important, no matter what your decision is on considering a banking RFP. With that bank and that banking partner, really all your partners are having them aligned with the goals and the strategy of your municipality. Do you have a policy in place that maybe mandates a periodic review? Is it annually? Is it every 3 years, every 5 years that you are going to at least look at your banking service partners? That's one way to consider that you have that in your policies. There might have been some personnel changing either at your municipality or at the bank. And so we're seeing a consolidation happen across the board in all different industries, but banking particularly, where a lot of the small local hometown banks are being purchased by larger banks. And so there's the service standpoint changes, the personnel changes. There might be, with some of those changes, there might be some service, lapses or changes that you're not happy with. And so that's certainly a good reason to look at, are there other opportunities out there for you to better align? Price and interest rates, competitiveness. So, banks are certainly involved in their local community, but banks are a business, right? Banks are looking to make money. And so a large deposit account or a large account like yourself as a municipality is a very profitable account for generally for a bank, either with those deposits that they can lend out if they can have those deposits at the bank at a very low rate, or the banking service charges as well. And so you are in a position to have some pretty competitive shopping if you were to look at an RFP. And as you're seeing, banking service charges are all negotiable, and the pricing could be all over the board. And so it's helpful to get some transparency into how banks are charging you. And then finally, certainly looking at the new services that are available. They're changing all the time, especially to manage risk from a fraud prevention perspective. That's really the hot topic these days, and making sure that your bank is aligned with those updated services. So as you think about building out a banking RFP or undertaking this, there are a lot of stakeholders within your municipality that need to understand, the why as to how you would go about doing this and the reasons. And so certainly within your payroll and your finance department and accounting department, but really how would this impact your IT, your purchasing department, billing and collections, being able to collect funds from your constituents. And then certainly letting know your council or your board that you would like to undertake this type of program or process. A banking RFP certainly can sound daunting, but there are tools and resources that you could utilize to get some additional information to help you think through this. So as you think about other resources that you could take advantage of, as you think about from a banking RFP perspective, certainly your neighbors. That's one of the goals of Ellers, is to make sure that our clients are well networked with all the other neighbors that they're working with and municipalities. So maybe one of your local neighbor municipalities has recently gone through a banking RFP and might have some best practices or even a template that you could look at or using. Your current financial institution might be able to even guide you and think through this. Consultants. So, I would say that Ellers is one that we could certainly help you with a banking RFP. That we do that on a regular basis with our clients. Definitely quite a few every year that we're helping banks or our municipalities navigate their banking RFP because they just don't want to tackle the complexity and all the pricing and such. There are certainly consultants that are out there that can do that for you. The GFOA definitely has some best practices with the website and even some templates to think through that if you wanted to tackle this on your own. And then certainly the Association of Financial Professionals. It's not a government site, but it is a association, again, of financial professionals that they have some standardized RFPs and for a fee, and then they can also provide some consultation for you as well. And so there are resources out there if you decide to undertake this, if you decide to review. And then now Donna's going to walk through really how would you undertake this if you decided to do this yourself, and what are the tips and tools that we can provide as you think through this along the way.
Thank you, Ryan. So for purposes of today, for our discussion, I'm going to focus on drafting the RFP and then evaluating the responses against a prescribed matrix. Okay. Well, let's start off with developing an evaluation matrix. Now, I always suggest on the prior slide, developing an evaluation matrix is something that I suggest you do before you even start writing the RFP. Sit down with all of the involved parties and determine what is important to you and how do you want to weight the different factors, the different criteria that you're going to evaluate. If you have this objective matrix, it's going to be a lot less emotional or subjective when it comes down to trying to evaluate the respondents and the financial institutions and try to compare apples to apples. Okay, so once you've determined how what are the evaluation points that you want to include and how important are they against relative to each other, then you can sit down and write the RFP. Once you've written it, you're going to determine who it's going to go to. Do you want it to go out to everybody only within your city limits? Do you want to include outside financial institutions? As we know, with services like remote deposit and all the electronic banking that we do, having the bank branch across the street isn't as important as it used to be. So who do you want the RFP to go to? And are you going to publish it simply by emailing it to the people that you want it to go to? Are you going to publish it on your website? And then once you get the responses back, you're going to evaluate them against that matrix that we've already put together. You're going to narrow it down to a few finalists. And if you determine you want to meet with them to determine whether it's going to be a good fit, you want to ask them some clarifying questions or maybe do a demo of their online banking products and services, get a feel for how the relationship would function on a day-to-day basis. This is the time to do that. So let's move forward and take a deeper dive into writing the RFP and what you need to include. So it's important to include your current situation. What does your current banking system look like? How many accounts do you have? What products and services are you using? But then also talk about your future. If you have some additional products and services that you want to evaluate and that you may want to add, make sure that you include things that you want to take a look at. This is a good place for you to ask the respondents to be consultative. Ask them, hey, what else do you think that we should be utilizing that we're not? Okay. You're going to need to include questions about the financial institution themselves. You want to make sure that you are partnering with a good partner that's going to be there in the long term. So they need to have good credit quality. Obviously, you have to make sure that they can offer the products and services that you need. Now, for example, I did a banking services RFP for a client last year, and the reason they were going out to bid is because they had a fraud perpetrated against their account, but their current bank didn't offer positive pay. So we did a very quick request for proposal and found a bank that could offer our positive pay and got them transitioned. You're going to need to know who the relationship team is at the bank that's going to be servicing you. Do they have longevity and tenure? Do they have turnover? Because nothing is worse than having a representative that changes, every 6 months or every year, and then you have to reacquaint yourself and get to know them again. You're going to need to include your volume levels. So how many checks do you write? How many checks do you deposit? Do you use positive pay? All the different services that you might utilize, and they're going to need to know the volumes, because if you have high volumes, they're going to price them at a discount. Okay. Also, let them know if you have seasonality in your highs and lows in terms of both not only your volumes of your activity volumes, but also your balance levels. I would request some references of clients that they currently utilize or currently have that utilize the same products and services that you do, and maybe have similar volume levels. And I know that, they're going to generally give you references that, of course, they think are going to be positive, but you can ask open-ended questions such as, where do you think they could improve, or what's your favorite thing about the relationship? So you can ask some questions that'll give you a better flavor for the partner that they might be. Of course, you need to include deadlines. You need to let them know if you're going to have a certain period available for questions and when the RFP is due back to you. And make sure that you include a contact for questions or clarifications for them. Okay, so now that we've written the RFP and we've gotten the responses back, now what? Well, now we plug it into our matrix and try to make it as objective as possible, which is not always easy. Current relationships, as a couple of your questions alluded to, it's painful. It can be painful to change banks. Okay, so the idea is that if you're going to change banks, you want to make sure it's that you have very good reasons to do so. I always recommend that you give a few bonus points to your current bank if you're happy with them. If you are going out to bid because you're dissatisfied with their quality level or their products or services, obviously they're not going to get any points for that. However, if you're happy with the relationship, they ought to get a leg up. So if all else is equal with the other banking providers, you would stay with the current provider. Okay. So next thing, you obviously need to make sure that if they can offer you the products and services, they're going to get the required points on the matrix. Make sure they have a well-detailed, thought-out implementation plan in case you are going to change banks. You want to make sure they're going to be with you every step of the way and make it a smooth transition. Their quality needs to be very high for their services and their products. Make sure that their personnel has experience and is stable. If it's important to you to have the bank nearby, a branch nearby, make sure that you weight that. And obviously, if you want them to be part of your community and be active in your community, you're going to make sure that you weight that as well. So in summary, just, like a lot of things, answer these main questions. Who, make sure that you involve your internal partners and know who the financial institutions are that you want to send the RFP to. Why? Make sure that you know why it is that you're going out for bid. Is it time to do your due diligence? Are you unhappy? Are you looking for new services? I did another RFP last year for a fairly sizable city here in Wisconsin, and they ended up changing banks because they were able to save $10,000 a year in fees and higher interest rates. So between higher interest rates on their balances and lower fees, $10,000. So it was worth going through the process of changing banks and going through the RFP process when you can save $10,000 a year. How? Are you going to do it in-house? Are you going to utilize a consultant? Are you going to ask for hard copies to come back to you, or do you want just an electronic response? Are you going to post it on your website? So you need to talk about the logistics of how you're going to go about the process. And then what's going to be included? Is it all of your standard depository and disbursement products? Or are you going to have a P card in there? How about merchant? Maybe you're accepting credit cards, and so maybe your merchant will be included in there. So make sure you know exactly what's going to be part of the process. All right, so this is the end of our presentation. So we're going to open it all up to you for a final question and answer. And for that, I'll ask Tammy and Ryan to join me.
Thanks, Dawn. We do have a couple of audience questions. First one, how long does the RFP process take?
I would say you're going to need at least 2 months from beginning to end. And I should say 2 months from when you have the RFP written. So it may take you, a month before that to gather your internal partners and review what's going to be included in the RFP process. So I would say, 2 to 3 months probably.
Okay. Great. And the next question, if you don't have time to actually set up an RFP and just want to have your team set it up, what do you need from me?
I would say the most helpful place to start is to send me an account analysis statement, because that gives me a good flavor for the products and services that you're utilizing today and the volume levels that are associated with the products. And then after that, then we could have a verbal conversation about your pain points or what you're hoping to accomplish by going out for bid, what you're happy with, what you're not happy with, and maybe products and services that you don't utilize that you would like to evaluate whether they're beneficial for you moving forward.
Yeah, and it's an interesting time to consider that, especially in a low rate environment, as Don alluded to, this past year, that whereas you might not be able to, we're demonstrating today that you can certainly make money on investments and deposits and balances, but the flip side is maybe the equation is maybe there's a way to save more money on going through the banking RFP process for your municipality than to really get a better rate of return. So that in a low rate environment, any way to save a few dollars here and there, certainly. $10,000 a year was we were very, very excited and happy about that win that we could help provide for that client and help facilitate that process. But every size of municipality is a little bit different in the nuances they're looking at. But there is a lot of complexity here, and let's be honest. Generally, investments in treasury management and evaluating banking relationships isn't always on everyone's top of their list, because there's so many other things that are pulling at you from a city administrator or a finance director standpoint. But if we can help provide any tools or resources or commentary or help or advice, we're certainly happy to partner with you and help you along the way, because it can feel daunting. But if we could take these in bite-sized chunks, there's definitely different ways to accomplish the goal.
That's a good point, Ryan. And our final question for the day that we'll take is actually, how long does the bank transition process take?
Well, you're going to want to run in parallel probably for maybe 2 months, I would say, and allow probably at least a month to implement the various products and services. It depends on how many products and services you have and the complexity of them. But I would say if you have a month for the transition and then run in parallel for another month or 2.
Mm-hmm. And that bank, that RFP process, or that awarding that new bank, that's a key component of understanding their transition plan and how they are going to see themselves help you facilitate that process. And so that would be scored pretty highly on this process as well. Where can they help reduce some of those pain points in that transition? And even be part of your scoring matrix, not just that they're going to give you a better rate and leave you to do everything yourself, but is there other ways that they could help you with that transition too?
That's really great. Love the questions, and certainly know that we are here to help. Do either of you have any final thoughts before we wrap up for the day?
Yeah, thank you all for listening and taking time out of your lunch day today, and a beautiful day to think about how to best align and serve your city or your municipality on your banking partners. And we are privileged to work with many of you in a variety of capacities on the treasury and investment side. And if you have questions, it sounds like there was questions about the fraud protection or fraud prevention tools. We're certainly happy to continue these conversations. This doesn't have to be a once a year thing, but use Ellers as your resource. We're happy to partner with you along the way for any and all questions you might have. So thank you for your time today.
And I would just say that your banking partner is just that, they're your partner. And so never hesitate to reach out to your banker, your treasury management professional, and have conversations with them and meet with them on a regular basis, because they are there to help you. And if you treat them as a partner, it can be a great relationship.
Mm-hmm.
Great. Well, thank you both so much. Dawn and Ryan, you did a fantastic job walking us through the banking services today. And that's really all we have for you guys today. So I want to thank our team for their insights, and thanks to all of you for taking time out of your busy day to join us. Please note, both a copy of today's presentation and a recording of the session will be posted to your virtual attendee hub. So you have that available for future reference and use. Because we're always interested in learning about ways we can make your virtual experience more dynamic and deliver content that is most valuable to you. We ask that you fill out that brief survey for us. You can do this one of two ways. On the right side of your screen, there is a survey button under the chat and Q&A buttons. You can click on that survey button right now if you want to take the survey at this time. If you don't have time today, you will receive an email with a link to take the survey tomorrow afternoon. We do hope that you'll take time to give us your thoughts on what we did well, what we can do better. And of course, for those of you who have joined us over the last couple of months, for each of our seminar sessions, we thank you. We hope you enjoy this summer with your family and friends, and we look forward to seeing you in person next February at the Kalahari for our 2022 Public Finance Seminar. Enjoy the rest of your day.
Thank you.
Thank you.